Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 3, episode 14. And today I want to walk you through the top 6 priorities that professional and educated investors focus on, especially when we leverage real estate investing as our main vehicle to generate multiple sources of income and short-term, long-term wealth, or whatever you want to call it these days now at this point. And so, yes, you kind of see this weird thing around me because I'm using a virtual background now at home in my studio. I have a green screen, so you don't see it as much. And many of you know, if you've been following my Daily Dose with Tim, I am now actually in Toronto, Canada already, getting ready for the multifamily conference this weekend, as I mentioned. And I'm having the privilege of being able to teach at this conference and also share the stage with some really industry leading professionals. And I'm just very, very grateful and humbled to have this opportunity. And if you've been watching me and you're going to be at this conference, please come by and say hi. I will also be at the Trust Your Talent booth at booth number 211, I think. So anyways, look for us. You'll see the logo anyway. With that said, though, today, what I'm going to do is I'm actually going to leverage one of the presentations that we typically use when we are teaching. So this might actually make it a lot easier to follow along. So this is what we call the top priorities in real estate investing. And the funny thing is, I understand, especially during turbulent times, and even when it's not turbulent times, even when the times are good, meaning the value just going up, there's still a lot of emotional battles that we sometimes have to go through when it comes to investing in real estate. And so that's why really today I want to take a few minutes here and focus on the priorities with you. Because the funny thing is, even in life, if everything is a priority, nothing is. So I want you to think about that, because this is one of my coaches one of my coaches sayings, and I don't know if it's really a saying or it's just that it kind of came out and it really stuck with me, because it is so true. If everything is a priority, then nothing really is, because then how are you going to know how to delegate your time, your effort, your energy, in this case your money, and maybe even your money partner's funds and resources into the best possible deal? Okay. And so again, the best possible deal, it doesn't always have to mean that it's the best cash flowing one or the best ROI ones. It simply means that these are the type of deals that fit in the grand scheme of things when it comes to contributing to your financial goals. We keep on emphasizing this. I keep on emphasizing this with everybody. It's the fact that we are investing for a reason. And that reason largely is because there is a financial goal we want to hit. So if we're not doing that, then what's the point? So coming back here, the top 6 priorities, I want to share this with you. Number 1, it is definitely positive cash flow. It is always positive cash flow. And the funny thing is, lately, when I'm on social media, I am noticing a lot of people that are now coming out, instead of real estate, they're talking about buying businesses. And the reason why is because these businesses actually spit out profit at the end of every single month. And that's no different than real estate. Once again, we don't want to go through buy, rent, and pray all the time, okay? And in fact, we don't want to go through buy, rent, and pray at all. And when you learn how to do this properly, what I mean by that is, I get so used to when you're saying things like when you do learn how to do this. Learning how to do this meaning learning how to leverage real estate as an asset class to create multiple sources of income and long-term wealth. That's really the short form of it. And however, I understand that some of you might be complete newbies, and that's totally fine, because you are still assessing whether or not this is the right asset class for you. However, I will just say this right now, whether or not this is the right asset class for you, if you're learning to become a more educated and more professional investor, meaning perhaps you still have your 9 to 5, maybe you have a very decent paying job, you just want to increase your financial capabilities on the side a little bit. whatever asset class that you end up choosing, I really, really hope that you find strategies that will at least not just feed into the long-term equity and portfolio income bucket, as we discussed during Wheel of Wealth. It also feeds into either earned income or passive income at all times. Otherwise, it is not going to serve you well. And if you actually watch the previous 2 episodes, when you take inflation and sometimes cost of borrowing into consideration and into your actual calculations, again, the last 2 episodes probably arguably are some of my favorite episodes so far that I've done all 3 seasons across, simply because of the fact that we actually got a chance to look at what buy, rent, and pray really means, or amateur buy, rent, and hold really means from a number standpoint. And so having a positive cash flow is going to be the key, simply because of the fact that this is what's going to make your property a viable business. You need to be running a viable business. There's only so much time that you can withhold on a money losing situation if you don't calculate it properly. Again, if you're going through the BRRRR process initially, it is not going to spit out cash flow on a monthly basis, and that's okay as long as you've actually factored that in your overall deal analysis. However, cash flow, your net profit every single month is what's going to make your business viable, your property investment viable, and sustainable in the long term. And so with that said, priority number 2 is what we call ROI, return on investment. Return on investment. Return on investment typically has a lot of different factors and numbers that get calculated in. However, I know that a lot of people, they sometimes will say cash on cash is the same thing. And I would definitely argue that cash on cash is not the same thing. Cash on cash versus return on investment. The one crucial difference is that cash on cash is typically measured on an annual basis. That time frame is given. So for example, if you actually invest $1,000 into something, and then after 1 year, your $1,000 is now worth $1,100, okay? And your money is still left in there. That means your first year's cash on cash return is 100 net profit divided by the initial investment, 1,000. That is 10% right there. Let's say the second year, we're not going to compound this, okay? We're not going to compound this. The second year, let's say you take out the $100 because you said, well, you know what? That's gravy. I'm going to take it. I'm going to use it. I'm going to keep my $1,000 principal rolling into this investment. And the second year, let's just say that at the end of the second year, your $1,000 now turns into $1,200. So that means your net profit is $200. And that means your cash on cash that year is 20%. However, let's just say that you did not, follow me here, if you did not cash out your $100 in the first year, and then you did not cash out the $200 until the very end altogether, that means your entire return on investment during that 2-year period is $300, okay? $300 net profit divided by $1,000. Now you have 30% return on investment. However, if you're doing a non-compound calculation and you slash it in half, now your cash on average per year is 15%. So I'm hoping that that makes sense to you. At the same time, though, that's why I want to make sure that everybody understands the concept of return on investment. Usually there is a beginning and there's an end transaction of during the lifetime of a deal, meaning you've gone in and you've come out of that particular deal. And in this particular case, because we're owning real estate, okay, or controlling real estate, that typically means that we no longer have that piece of asset under our management, okay? And this is, again, some of you have seen acronyms like AUM. AUM means asset under management. And so moving forward, number 3, financing / equity. financing/equity. So if you've had a chance to go back to season 2, because I know in season 3 we haven't gone into the income property discussions yet and modules and looking at case studies. However, if you've gone back to looking at some of the IP or income properties episodes back in season 2, then you understand, I keep saying this, the most important number in any calculations when it comes to a long-term hold is NOI, net operating income. Okay. And after NOI, then you actually will factor in your debt servicing. And after you've taken out debt servicing, then you can calculate your cash flow. Okay. Now, I know I don't have my whiteboard, my flip chart, my whiteboard here today. So I'm really verbalizing this. So I'm really hoping that as I'm speaking, you are able to follow along and make yourself a few mental pictures there. And I know if you've been watching the previous episodes, you can probably picture what I'm talking about already. Now, financing and equity are super important. So for example, when you're acquiring a piece of property, I'm just going to use Canada as an example because I know I have an international audience at this point. So I'm going to use Canada as an example because in Canada, in order for us to purchase a rental property, a minimum of 20% down payment or deposit in some other countries, as you call it, is the minimum requirement. Okay, the minimum requirement by lenders and by the government, really. However, what that really means is right off the bat, let's say if you're purchasing a property for $1 million, 20% minimum means that you need to come up with at least $200,000. And that $200,000, theoretically speaking, is your equity. However, educated investors, we don't see it that way, honestly. We see that equity as the money that may or may not hold, or may not keep, or may not stay. What does that mean? This, I want you to flip to looking at the other side, and that other side is the lender side, because by definition, when we're acquiring and leveraging and we put down 20%, we are borrowing the 80% loan to value. Okay, so we're borrowing 80%. So if you look at it from the other perspective, the lenders would like you to have some skin in the game. And that means that 20% is your skin in the game. So whether or not the market goes up or down, especially when it goes down, they have that 20% of your money as their protection. So once again, let's say if you bought something for $1 million today and you put down $200,000, that means you take out a loan for $800,000. Assuming in the next year, market's not doing so well, naturally speaking, the value is dropping from $1 million to 900,000. Do you think the bank is actually worried about it? No. However, are you feeling a little stressed? Absolutely, because that's your money. Your money is their protection. And this is also why a lot of the times when you get to a certain point when you are not able to leverage at 20% down payment, most lenders will ask you to start to go up in your equity stake. So they will ask you to come in with 25%, 30%, 35%, even up to 50%, so that they only have to come to the table at 50% loan to value, because you are what they are now consider high risk. And so they will want you to have a bit more skin in the game, and then they will come in and match the final purchase to completely fund that initial purchase of the project or the asset. Okay. And so I want you to think about it this way. And that's also why equity position, I understand so many of us, when we're not educated, we focus on equity. However, professional investors, what we want to do is, as I mentioned before, over and over again, it's the fact that we want to continue to learn to scale up every step we can, simply because having the scale is what's going to offer you the ultimate protection during up, down, and sideways market conditions. Okay, because I keep saying this, I think Starbucks, for example, is a brand that globally a lot of people can recognize. Starbucks, okay, do we think every single Starbucks coffee store is profitable? Many of us might actually think so, because a lot of times when we go to a Starbucks, or when we just look at a Starbucks, walking by it, driving by it, we see so many people and we're going, wow, they're selling a simple cup of coffee for $2 to $3 a day these days. And some of those fancier drinks are $7, $8, $9 now. They must be making a killing. Well, COVID lockdowns actually show this. And this is something that I've been saying for nearly 10 years now. Not every single Starbucks in this example is profitable. Okay, not every single Starbucks is profitable. And I will go as far as saying not every single Starbucks is profitable every single month. So what that means is sometimes, let's just say that location A, location B, maybe location A is doing better this month, location B is not so much, and then it kind of fluctuates. Okay, at the end of the day, I want you to think about it. Starbucks as a company, do you think they are profitable regardless? Absolutely. I mean, if you have doubts, just look at their stock prices and what they're offering into the public markets. Okay. So the idea behind all of this is, as professional investors, I also want you to start thinking about this, is that yes, it's always a tug of war between the priorities. And this is why we actually rank them. So there are times where you might make decision, okay, that you want to put in some more equity, not because of what the lenders want you to do. I know largely for us, it's because of what the lenders want us to do. However, now you can make different decisions to say, you know what, on this next project, because of certain criteria that are going for it. Maybe the future development opportunity around the area, maybe because it's in an area where the fair market rent is actually growing the most and you want to capitalize on it. Or maybe you've recently sold off another underperforming asset. You've taken out the equity. You want to put that equity towards this new piece of asset that's going to perform better already. And so again, this is why I say NOI is the most important number, because in this particular case, if your NOI is already strong, and when you come in with a bit more equity, what that also means is your debt servicing becomes a little smaller on a month-to-month basis. And so what you end up with is actually a much larger cash flow, which means net profit and net income that goes into your pocket and your bank account that will subsidize and fuel your life and your lifestyle. And I know I've kind of gone on there. It's a very, very big thought for many, many of us. And that's okay, because today I'm going to just share the top 3. And then in the next episode, I'm going to go into sharing the rest of the top priorities as well. And I will probably say this because starting tomorrow, I am going to be speaking at the conference, and I may not actually be able to go through the next 3, but I will definitely do something as well, even when I'm in the convention center, because I'm going to be surrounded by real estate investors, both new and experienced. So I'm pretty sure there's going to be some very interesting conversations that will spark something that I can share. Now, I want to make sure that you go back and revisit point number 3, everything I just said, and hopefully that makes sense. And if you need some clarification anywhere, make sure you comment, make sure you direct message me. I've been getting a lot of direct messages, especially for the last couple of episodes when it comes to the calculations for buy, rent, and pray. So I will take some time to answer those as soon as the conference is done, and that way we can have a better discussion. And once I have a different environment where I am not, camping out, just so you know, I am camping out in a building's common area at the moment. So this is how committed I am to push this forward on a daily basis. So with that said, thank you so very much for joining me again. I appreciate you. And most importantly, I really think that you need to take the time and give yourself a little pat on the back. Thank yourself, appreciate yourself for making the time to stick with me and to watch my Daily Dose with Tim, because what that's telling me is that you have the drive and the fire inside of you to really learn about financial education, as I did years ago. And it's what's fundamentally changed my life and allowed me to also change the lives of many other people. So with that said, 6 top priorities in real estate investing. Today, we've covered the top 3. Number 1, positive cash flow. You need that to be a viable and sustainable real estate investor. Okay. Don't let anybody else tell you otherwise. I don't care if the cash flow is $10 a month, $50 a month, based on the worst case scenario calculation, or $1,000, $100,000 a month. Doesn't matter, because it depends on the size of the asset. Don't let anybody else tell you that it is okay to not make cash flow in real estate. Number two, return on investment. We discussed how that is different from cash on cash return. So make sure you don't get those two confused. And last but not least, financing terms / equity. So again, I know it is coming up the conference time now, and I'm going to share the link and my discount code with you if you would like to come and join us. And I know sometimes there's last minute plans that get dropped, so that all of a sudden you go, you know what? I'm going to take this weekend, take this opportunity, and further my own knowledge, my network, and my financial education. So I look forward to meeting you at the multifamily conference if you're coming. If not, I will see you at the next episode of my Daily Dose with Tim. And I'll be coming to you noon Eastern time. And it's noon Eastern time for me today. It was a little adjustment there, since when I started, it was because I was home. And at home, it's 10 a.m. Mountain Time and 9 a.m. Pacific Time. Have a great rest of the day, everybody. Live well.